Namaskar, hello and welcome friends to Finnovision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is part of the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Real estate and forecasting of real estate returns. So friends, till now we have discussed things like equity returns and bond returns and what are the metrics and what are the ways in which we can predict their returns. Now we are going to discuss the real estate segment and try to understand how many ways or what are the ways in which we can measure their expected returns or future returns. Now, before we try to measure the returns, we have to understand a few unique characteristics that the real estate assets or the real estate domain has. So differences of real estate with respect to other financial assets, so-called financial assets. Financial assets means we're talking about equities, we're talking about bonds, we're talking about hedge funds, etc., etc. With these, they have a certain amount of difference. Now, these differences are, first is heterogeneity. So let's say in a single pin code, you are looking for a real estate property. And if you search rigorously, you will see that you may find that there are 10 kinds of variants of properties. There are 1-bed residences, 2-bed residences, 3-bed residences, 4-bed residences, villas, commercial properties, retail outlets, showrooms, garages, parking lots, and land parcels, and every kind of properties, even warehouses you might be able to find, right? And each of them are very, very different in the way they are behaving financially, in the way they will be behaving in terms of your leverage availability, in your liquidity, in your return calculations, in your investment calculations, everything. So they are very, very heterogeneous. In a single micro market, you will find n number of variants of properties. The neighborhoods may vary, the ticket sizes may vary, the builder may vary, the property quality may vary, the finish of the property may vary, the communication of the property may vary. All these variations are there. So this makes real estate a very heterogeneous domain. Then indivisible. Let's say if someone is trying to buy a 3 BHK in a proper town or a city, then that person has to pay the total amount to buy the 3 BHK. There is no sharing of the amount. If it is 10 million, you have to pay 10 million. If it is 1 million, you have to pay 1 million. If it is like 500,000, you have to pay the entire amount. So it is indivisible. It is not like equity where the entire ownership is distributed into hundreds or thousands or millions of retail owners or investors, right? It is not like that. It is indivisible. Now here, mind you, we are talking about direct real estate investment mostly. We're talking about real estate assets being purchased as a whole through direct investment. That is going to be our main focus in this segment. The third is immobile. Now, we are seeing homes which are on wheels. That is all right. But majorly, real estate means we are thinking about an immobile asset. If it's a hotel, if it's a home, if it's a villa, if it's a showroom, if it's a mall, if it's a warehouse, if it's a factory, everything you are considering is basically immobile in nature. So that is one more characteristic of real estate. Then illiquid. Now, because of the previous three properties, indivisibility, heterogeneity, immobility, high ticket size, the properties or the real estate assets tend to be very, very illiquid. Comparatively much more illiquid than other assets, especially assets like equity or assets like bonds or even assets like bonds, right? Now, these are the differences of real estate with respect to financial assets. Now, the next question is it also similar to certain other assets other than financial assets? The answer is yes. Real estate is very, very similar in behavior with respect to things like capital equipments or labor. Through capital equipments and labor, what do you get? You buy an equipment, you buy, let's say, a commercial vehicle or a trailer or a crane or a dozer or a offloader or a dock equipment. What happens is you directly use it or you rent it out and you get returns. Periodic returns. Same with labor. A classical example can be IT services companies. There, through the use of labor, the IT services companies are earning periodic income through licensing, through subscription, through building products, through building services, etc., etc. So, real estate is also in that way very, very similar to capital equipments or labor. How? The question is how you ask. It is it directly produces return in the form of services. Now, real estate can be rented out. It can be through subscription models. It can be through daily models. It can be through monthly models, yearly models, lifetime models. Any which ways, they can be rented out in many ways. And that renting of services is confined to one single location. So through real estate, one is looking, if it is being taken as an investment asset, then one is looking at earning income through services, which is confined to one single location. And also there is the aspect of capital appreciation also, which is very unique to real estate. Unlike equipments, which generally deteriorate, you can only get a residual value in case of a commercial vehicle or a crane or a dozer or anything of that sort. But in real estate, you can get actually capital appreciation if the investment has been done properly, if the valuation or the location of the instrument has been done properly. Now here, whatever we have discussed, all these things are very much related to direct real estate. Here we are mainly talking about direct real estate, right? All these things are pertaining to direct real estate. Now, apart from direct real estate, there is also another way of investing in ownership of real estate. Investing in ownership of real estate, that is called REIT, Real Estate Investment Trust. There, what is happening is a trust is being formed and money is pooled together, and then it is invested to buy, let's say, a single property. Now, there is one property in Mumbai which is called the Mindspace, and that has been taken over, let's say, by a company. And after taking over, that company has securitized this ownership and divided into fragments, which are called REITs. And these REITs, like mutual funds, like ETFs, can be purchased in the market. They can be traded in the market. So these are REITs. And in the short term, the thing is, in the short term, they tend to behave like equities. In the short term, they tend to behave like equities, right? But in the long term, the valuations, the prices, the returns tend to align with the real estate direct investment itself, right? So in the short term, they tend to have correlation with the equity. In the long term, however, they are very much parallel with the real estate valuations and pricing fluctuations and whatnot, right? Now, return calculations in real estate are done through something called appraisal. When you are talking about return calculations in real estate, there is a necessity of something called appraisal. Now, what is this appraisal? Let's discuss. Let's say we are looking at a certain micro markets where real estate transactions have happened. A micro market means we are looking at as small a place as a single pin code. Now, in this pin code, let's say real estate transaction has happened. And let's say it's a very high valued property area where only posh properties are there. So transactions are very infrequent and in between. So let's say first transaction. Now, we are looking at the transaction sequence of this micro market, very small micro market confined to a pin code over the last approximately 5 years or so. 1, 2, 3, 4, and 5. These 5 years, we are trying to understand what has been the transactions. Now here, the beginning, let's say 5 years back, transaction began somewhere here. The first transaction led to the second one led to the third one led to the fourth one, and like this it goes on year, right? One transaction, two transaction, 3, 4, 5, 6, 7, 8, like this it goes on, right? Now here, let me do one more thing. Let me also calibrate the price levels, okay? So micro market vertical, the vertical axis is the micro market pricing. It's not only the micro market, we're talking about the price in the micro market, right? So let's say it is calibrated in millions. 1 million, 1.5 million, 2 million, 2.5 million, 3 million, like this. So let me also write it down. 1 million, 1.5 million, 2 million, 2.5 million, 3 million, like this. So here the amounts are in millions. $1 million, let's say, right? Okay. Now let me complete the chart here. So the chart is, you can see it's a zigzag chart, right? It's a very zigzag chart. Ups and downs are there. It can depend on the market situations also. It can depend on the property type also, property quality also, and all these factors might be involved. But the transaction prices go like this. It's very zigzag, you can see. Now, because these differences are very high, let's say in the last period, you can see one price is here, see the hyphen, and the other extreme price is here. So it's like a difference of 1 million, like from 1.5 million to 2.5 million the prices have gone to, right? 1.5 million to 2.5 million. Now doing a trend analysis on this becomes very difficult. Doing a trend analysis on this kind of a thing becomes very difficult. So what does one do? What one does is takes a smoothed average or a moving average. So let's say in between 5 transactions will be taken together and a point will be drawn. Let's say the first 5 transactions are chosen. 1, 2, I'm circling them in red. So 3, 4 and 5. These 5 transactions are chosen and their average value is taken as the single point. Let's say the point comes somewhere here. Let's say the point comes somewhere here. I'm pointing it in green. Let's say the first point comes like this. Then, now the first, second, third, fourth and fifth points are taken to create the first point of transaction. Then for the second point, we take the second, the third, the fourth, fifth and the sixth. Then we create the second point based on that. Okay, let's say this point comes somewhere here. Again, I am putting the second green point. And in this way, we go on creating points after points after points. Okay, and let me also draw the line. The line which forms because of this can be something like this. Let's say it can be something like this. Now you can see here the zigzag curve has been replaced by a green, very, very smooth kind of a curve with a smooth trend, right? Now this has its benefits also. We can measure certain things like the mean. The mean return can be measured very easily without any bias here. But there are certain other problems to this smoothing also. Let me write here. This is the smoothed curve or the appraised curve, right? Now after this smoothing, the mean return is not affected. It is well estimated. So let me circle the mean return is well estimated. There are no biases here. But there are some other problems that happen. If you look at the left side of the chart, I have pointed out those problems. Firstly, the volatility is underestimated. The hugely zigzag line has now been reduced to a very, very smooth curve. So there is a problem here. We are misrepresenting the amount of volatility here. Secondly, this smooth curve tends to give an impression that the transactions are very, very frequent and it's a very liquid market, while it is not the case. It is made out of very, very infrequent transactions. And we have created a smooth curve out of moving average, not out of frequent kind of continuous kind of transactions. It has basically been smooth by taking moving averages. So that is the second point. The liquidity is overestimated, the volatility is underestimated. And the correlation. Regarding the correlation, because of the smoothing, the zigzag patterns are gone, and therefore what happens is there is a lead and lag of correlation with respect to other financial assets. It is not necessary that it will lead or lag. It can either lead or lag other financial assets or other domains of investments in terms of its correlation with those domains. Those domains means we are talking about it's the real estate correlation with equity, the real estate's correlation with bonds, the real estate's correlation with hedge funds, etc., etc. They create a lead and lag approach or a lead and lag pattern with respect to those markets, right? It's not consistent that it is always leading the hedge fund market or the equity market or always lagging the equity market or the bond market. It is not like that. It may sometimes lead, it may sometimes lag. Now, to solve this problem, we need to unsmooth the curve, and unsmoothing techniques are also mentioned in a later section. So we'll talk about that in a later section. But first, let us discuss the cyclicality in the real estate domain. Real estate cycles. Now friends, real estate is mainly driven by a balance of supply and demand. And this balance of supply and demand actually works differently for properties with different kinds of qualities. For example, for a high quality property, there are long lease terms, there are higher occupancy rates in an average, and the rentals are obviously therefore more stable. Higher the quality, longer the lease terms tend to be, higher the occupancy rates tend to be, and more stable rentals tend to happen there. But in case of a lower quality property, things tend to be more volatile. There is lesser occupancy. There is more sensitivity to the ups and downs of the business cycles or the economic cycles. The rentals are on average lower, obviously, and therefore, combining these 3 points, you can understand there is more volatility of returns. Now, what happens is real estate cycles happen in a certain way. Let's say when there is a recovery in the real estate market happening, there are certain features of it. Features like there is rising demand, there is rising occupancy rates, there is rising rentals, there is rising values of properties, right? Now combining these two, the market gets a hint, or specifically the developers and the consultants and the market participants as a whole tend to get a signal that more new properties will give more higher returns, which gives an impression that there is scope for more newer properties to be developed one by one. And this leads to what is called higher development of newer properties, right? So there is rising demand, rising occupancy, rising rentals, rising property prices, or rising property values, which leads to newer development of properties. New properties get developed one by one. This is the second phase, right? Now, over time, what happens is the supply in this way overshoots. And what we have is oversupply. So better markets result in more development, and more development of new properties eventually lead to oversupply. And oversupply eventually leads to things like declining values of properties, declining occupancy rates, declining rentals, and obviously which means there is a declining cycle in the real estate. Now the initial phase where there is rising demand, rising occupancy, rising rentals, rising property values, higher rate of development of new properties, this phase is called the boom phase. This is called the boom phase. And the phase where there is oversupply and constrictions and declining values of properties, declining occupancy, declining rentals, this phase is called the bust phase. Right? Now, once excess supply is created, that takes months or even years to get absorbed, which means the declining phase or the bust phase of the real estate cycle may take a long time for recovery. Reasons for a crisis. Reasons for a crisis. What are they? Let's discuss. The first reason we have obviously discussed right now, which is oversupply. Oversupply leads to declining property values, lesser occupancies, lesser rentals, all these things. This is obviously one of the reasons for a crisis. Then, second reason can be excess leverage. Excess leverage. A classic case is the financial crisis of 2008, where subprime loans which backed certain real estate assets were one of the main reasons for the financial situation. Speculation. Speculation means buying lower quality properties, taking higher leverage, or both at the same time. This kind of speculation also happened in the 2008 financial crisis. The fourth point is signals from REIT and MBS markets, mortgage-backed security markets. Now, because REITs and MBSs are basically derivatives of real assets or mortgages, what tends to happen is, in the short run, they tend to be highly correlated sometimes to the equity markets. And if the equity markets do not do well, like it did not do well during the 2008 financial crisis, the REITs and the MBS markets also get affected. And those affected parts in turn actually impact the real markets also, right? Everybody starts to get a perception that the real estate market is falling, it's nosediving. So there is a panic in the real estate market also. And there is a classic example of this which happened in the 2008 financial crisis. So the last 3 points are basically taken or drawn from the experience of specially the 2008 financial crisis. These are some of the reasons for a real estate crisis. Now, we have spoken about the characteristics of real estate, the way we measure real estate, the real estate cycles, and the reasons for the real estate crisis or the cycles to happen. Now we'll move into the actual measurement of real estate returns. So one of the most important metrics for real estate return measurement is the capitalization rate. This you need to remember. This is called the capitalization rate, right? How this is measured? This is measured as the ratio of the net operating income divided by the property value. The net operating income divided by the property value. And this capitalization rate behaves very much like the long-term interest rates, or it behaves like the long-term discount rate in effect, right? So capitalization rate, once again, is the ratio of the net operating income divided by the property value, market value of the property. Now, How do you measure the returns with the capitalization rate? On a long-term basis and on a short-term basis, the measurements are different. So on a short-term basis, let me discuss the short-term basis first. On a short-term basis, the expected return on real estate is the capitalization rate plus the net operating income growth rate minus the change in the capitalization rate. This is very much like the Grinold-Kroner model, right? Where the capitalization rate is much like the dividend yield. The net operating income growth rate has a real part and an inflationary part, right? And the cap rate, the change in cap rate is like the change in the PE. Obviously, there is no term for the change in the shareholding, right? There is no term for this, except that all other terms of the Grinold-Kroner model are equivalently present here. On the short term, this is the equation that holds when you are trying to measure the expected returns for a real estate. So once again, expected returns for real estate in the short run is the cap rate plus the NOI growth rate, net operating income growth rate, minus the cap rate. What happens in the long run? In the long run, the net operating income growth rate is very much similar to the nominal GDP growth rate. So in the long run, what we can do is we can add the cap rate with the GDP growth rate, nominal GDP growth rate, to get our expected real estate return. Now, cap rate has certain sensitivities to the financial markets. It is sensitive to the long-term interest rates, it is sensitive to the spreads, it is sensitive to even the debt to GDP ratio. Now, how these sensitivities play out, let us discuss that. Now, cap rate tends to be directly proportional or positively related with the long-term interest rates. The cap rate tends to be positively related with the long-term interest rates, which means during a contraction, the cap rates fall, and during market expansion, the cap rates keep on rising, which means this makes the cap rate a little bit pro-cyclical, right? Little bit pro-cyclical. During the bad times, bad economic times, they tend to go down. During good economic times, they tend to go up. But there is a balancing to this cyclicality also. How? Let's understand. Cap rates through research have been found to have some degree of positive relation to the credit spread. How? Let us discuss. The 3 to 5 year option adjusted spread of B-rated investment grade bonds was compared with the cap rate to the 10-year treasury bond spread. The cap rate to the treasury bond spread was compared with the option adjusted spread of 3 to 5 year term wise B-rated investment grade bonds. And what was found was that they happen to be positively related. So these are positively related. That is the spread between the cap rate and the 10-year treasury bill versus the option adjusted spread of 3 to 5 year B-rated investment grade bond. And this option adjusted spread tends to be counter cyclical. This option adjusted spread is actually counter cyclical, which means the spread goes down during good times and during bad times it goes up. Now this balances the pro-cyclicality of the cap rate. This balances the pro-cyclicality of the cap rate, right? These two factors balance each other. And other than these two factors, there is one more factor, which is the debt to the GDP ratio. Debt to GDP ratio. Debt means specifically to the housing segment and the non-financial segment. This segment of debt compared to the GDP, the ratio of housing plus non-financial sector debt with respect to the GDP is what we are talking about. Now the cap rate is inversely related, negatively related to the debt to GDP ratio, right? So the more the debt, lower the cap rate. The more the debt, the lower the cap rate. Which means when there are economic uncertainties in the real estate domain, that ensues, that can be seen as higher vacancy rates, right? Higher vacancy rates means the economy is going down, or at least the real estate cycle is on the declining side, and therefore the debt availability for real estate is lower. Lower debt availability is there, and lower debt availability means cap rate being inversely related will be higher. Higher cap rate, right? Higher vacancy leads to lower debt availability, leads to higher cap rate. So this is how cap rate is related to other financial factors. Now we discuss the risk premium approach for measuring the expected returns on real estate investments. The risk premium approach. So friends, we have done risk premium approach previously, right? First, we add the risk-free rate. Then we add the term premium or the length of duration premium. Then we add the credit premium. Then we add the equity risk premium, or you can say capital gains or losses premium. Also, we add the liquidity premium. Now here, I have written down all these premiums and we will ask the question whether each of them are necessary for real estate investment or not, right? One by one. Let's go. So first, the risk-free rate. Is the real estate investment better than a risk-free investment? No, right? So we add the risk-free rate here, obviously. Second, term premium. Real estate, is it an investment of 3 months, overnight, 15 days, or like 10-15 years or more? Generally, which kind of investment is it? It is a long-term investment. In fact, it is a very, very long-term investment in most cases. So term premium needs to be added. Credit premium. Now let's say you are an investor who has invested in real estate and given it up for rent. Now, obviously the returns from this investment is dependent on the credit quality or the credit situation of the tenant that you have, right? The rent has to be paid to you there for you to get the returns. So the credit premium has to be added because it is dependent on the credit condition of the returns that you're getting, right? The returns that you're getting are subject to credit situation. So credit premium needs to be added. Equity risk premium. This is basically a premium which is based on capital gains or losses. Do real estate investments go through the situations of ups and downs in market value? Yes, they do. So equity risk premium or capital gains or losses premium needs to be added. And last but not the least, is real estate a liquid investment or an illiquid investment? It is comparatively a much more illiquid investment, especially if you are investing in a direct real estate investment, right? So liquidity premium needs to be added. So all these premiums need to be added when you're trying to understand or gauge the real estate returns through credit premium model. All these parameters need to be added. Now, to what extent and what is the number, that varies depending on your micro market, depending on the market scenario, depending on your holding period. All these things will vary, right? Depending on the quality of the property, the variant of the property, all these things will be taken into account at that time when you are deciding the numbers, right? Now, the next method is taking into account an equilibrium method to measure the real estate expected returns. Now, can you use something like a Singer-Tehraar model for measuring real estate returns? Yes, you can. The answer is yes, you can, but you have to incorporate a few additional factors. First of the factors is when you are using Singer-Tehraar model, it is assuming high degree of liquidity. Now, therefore, you have to add this illiquidity factor. The illiquidity factor has to be added. Then, when you are looking at a Singer-Tehraar model, you are looking at global integration and degree of global integration. In case of real estate, it is generally a very location specific event. It is a very location specific investment. Even if you are invested in multiple portfolios, it is very much heterogeneous and location specific. Very local in nature the investments are. So the location specificity factor has to be added. The third point is when you are trying to gauge or predict returns in the future by the help of previous indexes for real estate, you must take into consideration the smoothing factor. As we showed before, there is a smoothing factor or appraisal factor in the charts or in the index values that you see. So you have to take that into account and then incorporate it into the Singer-Tehraar model before coming into any kind of conclusion. So these three factors you have to add to a equilibrium model: illiquidity factor, local specificity factor, and smoothing factor. Okay. Comparing public versus private real estate. Now, can you compare something like a REIT investment with a direct real estate investment in an apartment or a mall directly? With respect to investing in a REIT unit, can you do that? Yes, you can do that. But before that, you have to take a certain degree of caution or you have to process the data a little bit, right? So what is that processing? It's a 3-part process. If any of them are not done, you have to do that. So what are they? First is you have to unsmooth the direct real estate investment transactions. So for example, you have tried to understand the direct real estate figures from an index of real estate. That data is highly likely it is very much smooth. So you have to unsmooth that by applying certain techniques. Then when you are comparing those returns with respect to the REIT, you have to deleverage the REIT. You have to deleverage the REIT. And after deleveraging and unsmoothing of the direct real estate investment data and deleveraging of the REIT data, then also one more thing is pending. You have to check what kind of direct real estate investment portfolio you are comparing with which kind of REIT portfolio. So are you comparing a residential direct investment with respect to a REIT which is into commercials? You should not be doing that. You should take at par portfolios which are at par and then only do the comparisons. Okay, matching direct real estate investment portfolios with REIT portfolios, that is the third step. And if you do all these three steps, then you will find that generally the results are very similar. The figures are not very different. In the short run, sometimes the REITs can behave like equities. It is obviously more liquid, that is no beyond any question, but even in its pricing behavior, it behaves very much like the equity markets because it transacts in the same markets as the equity markets. It tends to behave in the short run with respect to the equity markets only, but in the long run they tally much more with the direct real estate domain, right? So therefore it will be very similar, and longer the term the more similar it will be, right? And one very specific advantage that REIT holders have in the long run is they capture a lot of the liquidity premium. We spoke about the liquidity premium in real estate return measurement, right, through the credit model. Now there is a liquidity premium added, but what happens to the REIT holder is the REIT holders become an owner or a partial owner of a real estate, but they get much higher liquidity. So they get the advantage of the liquidity, but they get the pricing in the long run which is very much similar to the direct real estate domain. So they can capture a lot of the liquidity premium, right? Long-term housing returns versus equity. We'll do a specific point-wise comparison between equity returns and long-term housing returns. So in the long term, across the countries, the correlation is much less compared to equity returns. So when you look at real estate returns in USA versus US real estate returns, so when you look at real estate returns in USA versus real estate returns in India, you will see they are a lot less correlated compared to the equity markets. For example, if you compare the BSE or the NSE returns with respect to the S&P or the Dow Jones returns, they will be much more correlated compared to the real estate returns of USA and India, right? Then, the next point is generally high with exceptions. So real estate returns or housing returns tend to be higher, especially for developed markets, with some exceptions, maybe UK and Switzerland, and for some period of phases, maybe USA also, right? At least in developed markets, this is the case. This may not be the case in case of emerging markets. Let me write it here. So this is for developed markets and it may not be the case for emerging markets. So you have to keep that in mind. Now, we will go to the next segment where we try to understand exchange rates and the influencing factors upon the exchange rate. We have done equities, we have done bonds, we have done real estate. Now, one more factor when you are investing is the exchange rates. Now, friends, we'll move into the next section where we discuss what are the factors which impact exchange rates of different nations or countries or different currencies. So, friends, till now we have dealt with bonds, equities, and real estate. And we must remember one thing, that whichever portfolio you are trying to invest in, it can be global, it can be nation specific, it can be sector specific, whichever way it can be, it is always denominated in some currency or the other, or even multiple currencies if you are looking at international investments. So exchange rate is a primary, very important factor that you have to take into account when you are trying to understand the expected returns of an investment. And that entails understanding the factors which influence exchange rates. So we will move into understanding which factors impact exchange rates. Let's start. Forecasting exchange rates. So we have a template here and we'll understand every aspect here. Let's not get confused. We'll start with one thing. Let's say there is a currency of country XYZ. We call it the XYZ currency, right? There is this XYZ currency. And globally, there are certain amount of assets, certain amount of products, certain amounts of services which are being purchased by this currency. So globally, certain amounts of assets, products and services are being purchased by this currency. And basically, when investors or when consumers are buying assets, products or services, what they are buying is value or utility, right? So the currency is dependent on one thing. One thing is the quantity of assets, products and services that it is denominating. And second thing is the value or the change in the value or utility that these assets, products or services have to offer, right? Now let's say, keeping the value constant, the amount of assets, products and services denominated in this currency goes up. The amount of money supply is constant, the value is constant, the asset, products and services amount goes up. So obviously this currency, XYZ currency, will go up, it will strengthen. Then let's say the amount of assets, products and services are constant, the money supply in XYZ currency is constant, and the value or utility of the assets, products or services go up. Then also what will happen is the XYZ currency will go up. Now let's say we consider a different situation. Let's say the value and the asset, product, services are constant. The amount of assets, products and services denominated in XYZ currency is constant. The value or utility they are offering is constant. The money supply goes up. Then what will happen? Then friends, generally speaking, the value of XYZ currency should move down. It's a very simple equation in those ways, right? Now let's do one more thing. Let's say the money supply is constant, the assets, products and services are also constant, but the value or the utility that it provides, the assets, the value of the assets or the value of the products and services or the utility of the assets, products and services go down. In that case, what will happen? The currency will go down, right? Keeping one factor constant and tweaking the other two, we can understand what is the impact on the currency. Now, in effect, the currency impact is a balance of all the three factors because none of them are constant. The money supply is changing, the value or the utility of the assets, products and services are changing. The amount of assets, products and services a particular currency is denominating with is also changing. So every factor is changing. Therefore, it is basically a net effect of the movement of all these three factors, right? Now, it is not only the actual movement, that impacts, it is also the expectation of change in movement that impacts the foreign exchange. So let me highlight this part also. Actually, if the things change, then the change happens, that is okay. But the expectation itself of a change also changes the exchange rates. So actual and expectation both have an impact on the exchange rate, right? Now, when we are talking about currencies, we are talking about nation-specific currencies, right? Right now, we'll not talk about cryptos or global currencies, right? We'll talk about nation-specific currencies. Now, when we are talking about nation-specific currencies, there are two things to check and two things that mainly influence the currency movements or the exchange rate movements. They are the current account and the capital account. Current account means what are the exports and what are the imports. Capital account means what is the investments that are going out of the country and what are the investments that are coming into the country, right? So these are the two main factors which impact the exchange rates. And talking about the factors or the intensity of their impact in the short run, capital movements, that is what is the amount of capital coming in and what is the capital going out of the country, impacts the exchange rate much more than the trade flows. Because trade flows readjust over a longer period of time. Because development of products, let's say a country is dependent on some other country for a product. Now today itself, if the government wants that they want to get rid of this dependency, they can start the policy changes and then the productions will happen and then the product development will happen, then the viability will happen and then the product will be created. So for the domestic consumers of that product, they need a lot of time to get something available within the country that they do not have to import anymore. Or let's say a country is looking to export higher amount of goods. Now to export higher amount of goods, higher production will be required. For that, higher capacity might be required, higher labor might be required, higher capital investment might be required. So all these things will precede the higher exports. So all these things imply that trade flows impact exchange rates much more slowly and much less in the short run specifically, especially in the short run, than the capital flows. Immediately speaking, the impact on exchange rates is much more based on the capital flows. What is the capital flowing in? That is what impacts the exchange rates much more. But we will go one by one. We will start with the trade flows and their impact on the exchange rates and then move on slowly to the capital movements, right? So one by one we'll do that. So first thing we'll discuss is the impact of trade flows on the current account or export and import of goods and services on the exchange rate. Okay. So number one point is trade flows. Now what do we mean by trade flows? Obviously by trade flows we are talking about exports and imports of goods and services. Generally speaking, the economy is much larger than the trade flows. The GDP is much larger than the trade flows. This means the impact of the trade flows on the exchange rates is much small. Impact is much small. Proportion of trade flows generally and ideally are small compared to the economy, which means impact is small or should be small. But what if the impact is large? Large trade flows in comparison to economy, high proportion of trade flows in comparison to economy can imply emerging crisis, right? Now, when we are talking about trade flows, we are also concerned with the pricing power of a country, right? We are talking about the purchasing power or the pricing power of a country, or we're talking about the cheapness or the expensiveness of goods and services, right? So in that regard, the point which comes into question is the purchasing power parity. Purchasing power parity. What do you mean by purchasing power parity? It means basically, let's say in country A, the price of an apple is $3. In country B, the price of an apple is $1. So generally speaking, over the long period of time, B should strengthen. The currency of B should strengthen, right? Which in turns means the country in which there is higher inflation, the currency of that country should weaken. This is the equation which expresses that. Okay. So what we are saying is inflation in A is higher than inflation in B. That means the currency of A will weaken with respect to B, which means exchange rate of A divided by B will go up, right? Now in theory, other factors remaining constant, this should be the case. But what happens is, in the short run specifically, the purchasing power parity does not hold. It fails to hold, especially in the short run. Now what are the reasons because of which purchasing power parity does not hold in the short run? The first factor is, here in case of purchasing power parity equation, we are assuming that the trade flows are free. That is, between A and B, there are no barriers, there are no tariffs, there are no restrictions, nothing. So this assumption is flawed. There are some kind of trade constraints, whichever it can be, generally there between countries. So flows are not perfectly free, right? Second point is, ignores capital flow impact. Now, as we have said, the capital flow impact precedes the impact of trade flows, because trade flow changes over a period of time in a more gradual, more smoother, more long-term manner. Capital flows have a much larger impact in the short run on the exchange rates. Here, while equating exchange rate with respect to only inflation, we have completely ignored the impact of capital flows also. Not only the trade constraints, but also the capital flow impact. We have also ignored that. Third point is changes in terms of trade. So trade terms are not always free flowing, that is one thing. And the second thing is that terms are also changing. The terms themselves are also changing, right? So all these three factors combined, that is capital flow has their impact, flows are not free, terms of trade are changing. These three things mean that real exchange rate is not zero. All these three factors mean that the change in real exchange rate is not zero. The change in real exchange rate is zero. This assumption is not true. And this is because of these three factors, right? And this is the reason why purchasing power parity in itself, especially in the short run, does not show itself directly in the exchange rates, right? Now, now friends, as we have said, exchange rates are a function of two things. One is the trade flows and the second is the capital flows. These two are the major factors. And among them, if you have to look at the sensitivity in the short run, then trade flows have a very low impact on exchange rates, while capital flows have a very high impact on the exchange rates, specifically in the short run, right? Now, because in the short run, the impact of trade flows is limited, this means both these factors are okay. That is, having a small amount of sustained current account deficit is okay, and having a large but a very transitory current account deficit is also okay. But having a large and sustained current account deficit, a large deficit which is sustained, is not okay. Now, what do we mean by small sustained current account deficit? Generally, it is considered around 2% of GDP or less, right? Now, the current account equation is given like this. X minus M is equal to S minus I plus T minus G. Here, X means export, M means import, S means domestic savings and business profits, I means investments, T means taxes, earnings from taxes, and G means government spendings. So here you can understand X minus M is equal to S minus I plus T minus G. Here deficit occurs at what time, friends? When X minus M will be negative, and X minus M will become negative when either investments are overtaking the savings and profits, or the governments are spending more than they are earning, or both are happening together. That is when deficits will happen. Now, investments are more than savings. This is much more sustainable than government spendings more than government earnings. This is much more sustainable. And surplus will happen when the opposite case is there. That is, profits plus savings is more than investments, and or earnings from taxes or earnings of the government is more than the spendings of the government, right? So this is when surplus happens. Now, sustained levels of surplus may not be possible because other countries will tweak their policies in such ways that that surplus gets nullified or decreased at least, right? Now friends, we have discussed the trade flows or the current accounts. Now we'll discuss about the impact of capital flows on exchange rates. So let's begin with that. Impact of capital flows on exchange rates. Let's say there are two countries, A and B, with their respective currencies being denoted as A and B respectively. Now here, A has a higher return. A's assets or A's portfolio of assets is giving higher returns adjusted for risk. So A has assets, products and services which have greater value or greater utility to the investors than B. Now what can happen is capital from B can move towards A, right? Capital from B can move towards A. Now let's say B is one of the countries, and let's say there are multiple other countries where investors are finding that A has very valuable assets with much higher risk adjusted returns. Then what will ensue is a three-step process. Let me explain to you what is exactly going to happen here. See, first, because of capital inflows into country A or the currency A, the exchange rate of A will strengthen. That means A denominated in other currencies will go down and other currencies denominated in A will go up. If B is denominated in A, this exchange rate will go up, right? So this is the first phase where investment opportunities are in plethora and investors are investing, and second step comes just after that where the opportunities start to saturate. And investors start to question if any further viable investments are there or not, or if the entire asset base has been overvalued. This is the question that investors start asking in the second phase. The perception is that currency A can be overvalued, that it has been over-invested upon. The currency has become too strong by influx of capital in a very fast pace. And this process is called overshooting. I'm underlining it with green. This process is called overshooting. And once overshooting happens, or the perception of overshooting happens, then there is the reverse perception, that is, now the investors start thinking that currency should fall. The currency should fall. This is phase 3, where investors start thinking that currency could fall, and they start taking capital out of that currency or that market or that country. And what happens is, due to this expectation, capital flows out of this currency, which in fact can fulfill the expectation itself, right? It can be self-fulfilling. So capital flowing out, which means the currency goes down and the asset prices come down, right? And the currency also weakens. SBA falls, that is, B starts to harden with respect to A. Initially what was happening was A was hardening with respect to B. Initially what was happening was A was strengthening with respect to B. Now the reverse happens, that is, B starts to strengthen with respect to A. So the strengthening and weakening of currencies is not a permanent or a unidirectional process. It keeps on seesawing or changing. That's what we can see here. Now what we'll try to do is, we'll try to give this phenomenon a mathematical expression.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.